Good morning to both of you.
Morning.
Good morning.
Alli, what are you telling your clients as far as whether this market is oversold and just overshot on the downside?
It feels bad, and what I'm telling my clients is that, crazily enough, I have now been through, 15, 10% corrections and 8, 20% corrections. And what you do at this point in time is you wait. You wait and see, you upgrade your portfolio. I think there are three things, we call them the 3 R's going on right now, that we need to have some sort of clarity around in order to have people come in and really buy here. We have to have some clarity on rates, how far are we going? We have to have some clarity on recession, are we still gonna see growth? And we have to have some clarity on the, just the general risks in the market, whether that is intentional shutdowns to be continued or geopolitical tensions that create further bottlenecks.
Phil, I feel like you have been an optimist throughout all of this,
Yeah.
right? And have been buying the sell-offs, which hasn't exactly worked to this point. Is that still your advice?
Yeah, Sarah, it's a lot of fun to come on the show and talking about being overweight stocks, right? But at some point, the best offense is a good defense. And I think that's what we're looking at right now. We actually are tilting a little underweight in stocks. And when have I ever come on your show and talked about that? However, we still have the view that we are not going into recession over the next 12 months. And Sarah, I think the biggest thing that caught our attention last week was not CPI. That debate was not going to be settled, as you said last week. That debate is going to be settled as we get through this year. But the biggest thing that caught our eye last week was with the S&P down over 2, interest rates were lower. So the negative correlation between stocks and bonds returned last week, which is really, really good for the balanced investor. And I think, with the VIX making a lot of headlines this year, it's up 40% from last year. The bigger story is the MOVE index, which measures interest rate volatility. That's up 70%. So if there's one thing that we're looking at, Sarah, that I think can control the narrative is, do we find a home, a ceiling around rates, which will make everyone feel better? Because this year there has been nowhere to hide, and that has to change.
Yeah, Alli, Phil raises an important point. A lot of people may be looking at their stock portfolio, but if they look at bond funds that they may own, it's just as ugly so far this year. Any advice there, or is it sort of the same, just stand pat?
So look, a lot of clients, if you have active management, then you have to think about it, or if you're in funds, because then you're actually potentially experiencing the loss as opposed to just mark to market. But I think that is why you are seeing so much quote unquote panic and such a grab for liquidity right now. Think about how long it has been since a balanced portfolio was down somewhere between 10 and 20%. We've had a bull market in bonds for, depending on who you ask, 20 to 40 years. We've had a bull market in stocks largely uninterrupted, with the exception of sort of an economic coma that was outside of the realm of economics and consumer behavior for 12 years. People are not used to this level of impairment to a portfolio. And so what I keep on reminding people is, first of all, when you have this much recession risk priced in, we're looking at about 40% recession risk priced into both the equity and the fixed income market, you sort of have this binary asymmetric view of the future. 50% of the time, if you don't get a recession, you tend to get 12% bounce in the next 12 months, as opposed to, if we do get a recession in the next 12 months, a 9% downside. This just came out of our equity research group. So when you're investing into markets where you do have asymmetric risk, like we have had on the other side in the bond market for a while, that's when you need to take action, and you have to make sure that your portfolio is really constituted of the things that work in this environment: defensive stocks, hopefully in the future, commodities, and a lot of market neutral hedge funds.